Imagine walking into a chaotic auction house where a man named Mr. Market runs up to you every single day. On Monday, he screams that a basic chair is worth $1,000. On Tuesday, he panics and begs you to buy that exact same chair for $10. Most people panic right along with him, buying at $1,000 and selling at $10. But back in 1929, one man figured out that Mr. Market's emotional mood swings were actually the secret key to building legendary, generational wealth. His name was Benjamin Graham, the mentor to Warren Buffett. While everyone else lost their shirts in the biggest stock market crashes in history, Graham's framework allowed his investments to thrive uninterrupted. By the end of this video, you'll know the exact psychological weapon that turned Wall Street's absolute worst days into the greatest wealth-building opportunity of all time. In this breakdown, we are going to walk through 5 crucial strategies that separate the wealthy from the broke. We'll look at the fundamental difference between investing and gambling, how to handle market panics, and the strict formula for buying assets at a steep discount. Stick around until the very end because lesson number 5 reveals the single mathematical safety net that Warren Buffett calls the most important concept in all of finance.
Lesson 1. Investing versus speculation. Know your game. In the late 1920s, millions of ordinary people believed they were genius investors. They threw their life savings at hot stock tips, watched the prices shoot up, and felt invincible. But when the market shattered in 1929, they discovered a brutal truth. They weren't investing at all. They were just gambling with extra steps. Benjamin Graham drew a crystal clear line in the sand. An investment operation is one that, upon thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. To break this down simply, if you buy a business because you've analyzed its balance sheet, understand its real-world profit, and feel confident it will survive a decade, you're an investor. If you buy a stock simply because its price went up yesterday and you hope someone else will pay more for it tomorrow, you're a speculator. Think of it like buying a house. An investor looks at the quality of the foundation, the neighborhood rental rates, and the long-term income the property can generate. A speculator doesn't even look inside the house. They just hope a bigger fool comes along next week and buys the front door key for double the price for double the price. Are you playing a game of real business ownership, or are you just buying digital lottery tickets and hoping for the best? Now, knowing the difference between investing and gambling is crucial, but it won't help you if you can't control your own brain when the market loses its mind.
Lesson 2. Mr. Market and emotional control. Imagine you own a small fraction of a local bakery alongside a partner named Mr. Market. Every single day, Mr. Market knocks on your door and tells you what he thinks your share of the business is worth. The catch? Mr. Market is wildly manic depressive. On days when he's feeling euphoric, he quotes astronomical prices, begging you to buy his shares. On days when he's terrified, he quotes absurdly low prices, practically begging to sell his shares to you. Most people make the devastating mistake of taking Mr. Market's price quotes as truth. When he panics, they panic and sell. But Graham pointed out that Mr. Market's job isn't to guide you. His job is to serve you. You don't have to agree with his mood swings. You can simply ignore him when he's crazy or use his emotional outbursts to your advantage, buying when he's in a blind panic and selling when he's overly greedy. Think of Mr. Market like an overly dramatic weather reporter. If he screams that a thunderstorm is coming, you don't burn your house down. You just grab an umbrella and keep going about your day. When you check your investment portfolio and see red numbers flashing, do you treat it as a fire alarm, or do you view it as a massive clearance sale on great businesses? But here's the thing. Mastering your emotions during a crash is only half the battle. To survive long-term, you need a strategy that protects you from yourself when the market is booming.
Lesson 3. The defensive versus enterprising investor. During the tech bubble, millions of retail investors spent hours every single day trading stocks, convinced they were Wall Street pros. They burned endless time and energy, only to watch their portfolios collapse. They made the fatal error of confusing time spent with results earned. Graham explains that your investing path should be determined by your personality and available time, dividing people into two distinct buckets: the defensive investor and the enterprising investor. The defensive investor prioritizes safety and freedom from effort. They don't try to beat the market. They aim to match it using automated, low-cost index funds and high-grade bonds. It's a set-it-and-forget-it approach designed for people who prefer to spend their lives building businesses or hanging out with family. The enterprising investor, on the other hand, puts in serious time and research. They dig into balance sheets, evaluate management teams, and hunt for deeply undervalued opportunities.
Here's the catch. Graham warned that if you try to be an enterprising investor without putting in the real effort, you will underperform even the lazy defensive investor. Think of it like cooking. A defensive investor buys a great pre-made meal at a fair price. Simple, reliable, and hard to mess up. An enterprising investor buys raw ingredients and cooks a gourmet meal from scratch. But if you try to cook without knowing the recipe, you'll just end up burning down the kitchen. If you're enjoying these insights so far, drop a quick like on the video. It tells me to keep making deep dive book summaries like this one. So, are you willing to put in hours of research every single week? Or does a set-it-and-forget-it, hands-off strategy fit your life better? Now, if you do decide to take the hands-off route or want to keep your risk low, Graham gave us the ultimate framework for managing your money across good times and bad.
Lesson 4. The 50-50 portfolio and dollar-cost averaging. In times of economic panic, people tend to sprint to extreme ends of the spectrum, either putting all their money into speculative stocks or stashing it under the mattress in cash. Both extremes usually end in disaster. Graham introduced a remarkably simple, bulletproof asset allocation rule for the defensive investor, the 50-50 split. Keep 50% of your total funds in high-quality stocks and 50% in secure bonds or cash. If the stock market skyrockets, your stock portion grows to, say, 65%. That's your cue to rebalance. Sell some stocks and buy bonds to bring it back to 50-50. If the market crashes and stocks drop to 35%, you sell some bonds to buy cheap stocks. This simple rule forces you to automatically buy low and sell high without ever letting your emotions dictate your moves. Pair this with dollar-cost averaging, investing a fixed amount of money on a set schedule, month after month, regardless of whether the market is up or down. Think of it like buying groceries. If your favorite coffee goes on sale, you don't stop buying it out of fear. You stock up. Dollar-cost averaging ensures you naturally buy more stock shares when they are cheap and fewer when they are expensive. Are you constantly trying to time the market's tops and bottoms, or do you have an automated system that neutralizes your emotions? Now, we've arrived at the most critical lesson of the entire book. Everything we've discussed comes down to this one fundamental concept.
Lesson 5. The margin of safety, the ultimate safety net. Imagine an engineer building a bridge designed to hold 10-ton trucks. Does he build the bridge to support exactly 10 tons? Absolutely not. He builds it to hold 30 tons, so that even if an oversized vehicle drives across during a massive storm, the bridge remains standing. In investing, that extra weight capacity is what Benjamin Graham called the margin of safety, the single most important concept in all of finance. A margin of safety simply means never paying full price for a stock. If you calculate that a company's real intrinsic value is $100 per share based on its profits and assets, you don't buy it at $100. You wait for Mr. Market to throw a tantrum and offer it to you for $70 or $60. That $30 or $40 gap is your buffer against human error, unexpected bad luck, or economic recessions. If your calculations turn out to be slightly wrong, or if the company faces a temporary crisis, you still won't lose your shirt. Remember the chaotic auction house we started with? The reason Graham wasn't destroyed by market crashes was that he never bought shares unless Mr. Market offered him a massive discount. He built a bridge so strong that no crash could tear it down.
To build lasting wealth like Benjamin Graham, keep these 5 principles in your back pocket. 1. Know your game. Make sure you're actually investing based on business value, not speculating on price swings. 2. Master Mr. Market. Let market mood swings serve you. Never let them dictate your decisions. 3. Pick your lane. Decide if you're a hands-off defensive investor or an active enterprising investor. 4. Automate your strategy. Balance risk with a 50-50 portfolio split and dollar-cost average consistently. 5. Always demand a margin of safety. Never buy an asset without a huge buffer for error. If you apply even one of these framework elements, you'll instantly place yourself ahead of 90% of retail investors. Which of these 5 strategies are you going to implement in your own portfolio first? Let me know in the comments below. If you found this breakdown valuable, hit the like button and subscribe for more deep dive financial book summaries. Thanks for watching and stay rational out there.